Advantages of bonds over stocks. Bonds, while a more conservative investment than stocks, can offer certain investors some very attractive features: safety, reliability of income, potential of capital gains, diversification, that means you are diversifying into a different asset class, and sometimes tax advantages also. Why are bonds considered safe? Bonds are considered safe because in case the issuer is liquidated, goes bankrupt, then the bond holders are paid before preferred and common shareholder. So they have to be paid first, and then only money can be paid to a preferred shareholder, equity shareholder, or a common stockholder, right? In the event a company skips a payment or violates the covenants of the indenture, the creditor may force it to bankruptcy to protect the value of their investment. So if if the issuer fails to pay the interest on the bond, then you can file a case in the court saying that this company should be taken to the insolvency, and the money so generated should be paid to the bondholders. Right, so you can force a company into insolvency if you are a bondholder, and they don't pay you the agreed interest payment or the principal payment. So safety of the bond is partial. Safety of the bond is partial because they would be paid before equity shareholder, but that doesn't guarantee that they would be paid, because they have some guarantee built into them that if the statutory obligations and other obligations are paid and still money is remaining, first the bondholder would be paid, and after paying of the bondholder, whatever is remaining would be paid to the equity shareholder. So they are ahead in line to get money in case of a bankruptcy filed by a company. So I am not saying they don't have risk. I am not saying that at all. So if there is money, they will be paid first before the equity shareholder. That's the only advantage they have. And I am not saying that they are safe. Please understand, they are not safe. They might be safer than a equity shareholder. So Franklin needs a totally a different time frame to discuss. But what I can say is, in case of Franklin, they bought bonds of companies which went bankrupt or had hard times, and they could not even pay back those bonds which the Franklin Mutual Fund owned at that time. Because the company needs money to pay off. If they don't have money, they will not pay off. Whether you are an equity shareholder or bondholder, it doesn't matter. But yes, if the company would have money, they would have paid first to the bondholders, and then they would have paid to the equity shareholder. So what are the various terms associated with the bond? And we take them one by one. First is the coupon rate. What is a coupon rate? What is a coupon rate? Coupon rate is the promised annual rate of interest from a bond. Right? Coupon rate is the promised annual rate of interest from a bond. It is fixed at the time of issuance for the life of the bond. It is fixed at the time of issuance for the life of the bond. To determine the annual interest payment, multiply the coupon rate by the face value of the bond. Interest is normally paid semi-annually, and the semi-annual payment is 1/2 of the annual promised rate of payment. The coupon rate is the interest rate of the bond. What is face value? It is basically the amount to be paid at maturity is the face value. Bond may be issued at par, that means it is issued at face value and matures at face value. It might be issued at a discount and maturing at face value, as we saw in a zero coupon bond, right? So face value is what? It's not the initial amount. It's actually the maturity amount of the bond is called the face value. And usually the coupon rate is a percentage of face value. What is term to maturity? Term to maturity is the remaining life of the bond, right? So I issued a bond for 10 years and already 5 years have gone by. So term to maturity is 5 years, not 10 years. Do not confuse term to maturity with the original maturity, which is the life of the bond at the issuance. It is the remaining life of the bond is called the term to maturity. Now we come to a term which is called yield to maturity. Now we come to a term yield to maturity. So face value is the maturity value of the bond. Whatever principal is paid at maturity is the face value. So zero coupon bond are issued at discount, mature at face value. Right? So you have to see where it is issued. By default, face value means the maturity value. Yield to maturity is basically the IRR of the bond, the internal rate of return of the bond. If you buy the bond at today's price, hold it till maturity and reinvest all the intermediate coupons at this rate, that resulting rate is called the YTM or IRR of the bond. I again repeat, if you buy the bond at today's price, hold it to maturity and reinvest all intermediate coupons at a given rate, that resulting rate which you get, the resulting return which you get from the bond is called the YTM or IRR of the bond.
Reach out today and let's do it professionally.